Imagine if there was an account that let you dodge taxes 3 different ways, allowed you to cover your medical bills, and it secretly built you a retirement nest egg while you weren't even thinking about it. Sounds like a financial unicorn? Right. Well, it exists. It's called an HSA, and most people are using it completely wrong. In this episode, I'm revealing how smart people are turning this health account into a tax-free wealth building machine, and how you can too, starting today. So first off, let's kind of start off into what is an HSA. An HSA is essentially a savings account that allows you to contribute money to it pre-tax to pay for qualified medical expenses. Now, it is unlike a flexible spending account. You might have heard of these, an FSA. It is not a use it or lose it. It rolls over year to year for you. And you can withdraw from an HSA tax-free if you are using it for qualified medical expenses. Now, this term qualified medical expenses can really cover a lot of different things. It could be prescription meds, it could be co-pays, it could be over-the-counter medications, it could be first aid supplies, it could be home health care items. There's a lot of things that qualify as qualified medical expense, and so this can be a super powerful tool for you in that wealth building area. So let's talk about what are the benefits of an HSA. And we often talk about this as a triple benefit. You get a tax deduction going in, you get tax-free growth inside the HSA, and then withdrawals are tax-free if they're used for qualified medical expenses. So I like to kind of compare this to other retirement accounts because that's what's fresh in people's mind. If you have a traditional retirement account, you get a tax deduction going in, you get deferred growth, so you're not paying taxes when that account's growing, but when you withdraw funds from a traditional account, you're getting taxed on it. Now, let's flip the other corner. Let's look at a Roth account. With a Roth account, you get no tax deduction going in, but it grows tax-free, and withdrawals from that account are tax-free during retirement. Well, with an HSA, it kind of combines the best of both of those accounts. You get a tax deduction going in, the earnings grow tax-free, and you get tax-free withdrawals if you use it for qualified medical expenses. You don't even have to wait for retirement to use it for qualified medical accounts. The other benefits of an HSA is it is not a use it or lose it. This is an account that you put money into it. You could let that money sit in there for 5 years, 10 years, 20 years, and if you don't use it, you don't lose it. So it is not a use it or lose it account. You can continue to let that money grow. The other benefit of an HSA is that you can invest inside the HSA. So don't think of an HSA as just an account that you put money into and you don't do anything with it. It never grows, it just kind of sits there. You can invest the funds inside an HSA for growth. And remember, that's tax-free growth, which is the best kind of growth that you can have. The other cool benefit with HSA is that it's portable. If you go from employer to employer, health plan to health plan, it can move with you. It's not specific to an employer or anything like that. You can utilize it with any employer that you might have. Now, we're going to talk about in a little bit some strategies to help maximize wealth utilizing an HSA as your vehicle for that. And you might be saying, why are we talking about this now? Well, the main reason now is that we're early in the year yet. You still have time to make sure that you're funding this HSA as much as possible. And we always say that regardless if you're a W-2 worker or a business owner, if you qualify to fund an HSA, you should be putting the maximum amount into it each and every year. And we're going to talk about the benefits of why. So first off, what are the contribution limits? How much can you put into an HSA on a yearly basis? And if you have an individual health plan, you can put up to $4,300 into an HSA. And if you have a family plan, you can put $8,550 into an HSA. Now, if you have a high deductible health plan, and that's one of the requirements, we're going to talk about what qualifies as a high deductible health plan. But if you have a high deductible health plan in place by December 1st of the year, they consider you in place for the entire year. So you're good to go ahead and fund that as if you had a high deductible health plan for the entire year. So let's say you don't have a high deductible health plan January through November, but starting December 1, you can fund an HSA its full amount for that entire year. Now, we're going to discuss again other eligibility requirements right next, and we're also going to talk about some powerful tax strategies to utilizing this HSA. But real quick, if you're looking for tax strategies that you can actually implement, I built a software called TaxHelm. We don't just show you how to save on taxes, we help you turn those strategies into real dollars saved with clear, step-by-step guidance and full implementation. If you're serious about paying the least amount of taxes legally possible this year, click the link in the description and book a free discovery call with our team. All right, back to HSAs. So we talked about in order to qualify for an HSA, you have to have a high deductible health plan. What does that even mean? First off, a high deductible health plan means that you have a minimum deductible. And that minimum deductible is going to be different if you have an individual plan or a family plan. If you have an individual plan, the minimum deductible you can have to qualify as a high deductible health plan, which allows you to then contribute to an HSA, is $1,650. If you have a family plan, it's $3,300. You also have to have a max out-of-pocket amount in order to qualify as a high deductible health plan. And that max out-of-pocket for an individual is $8,300, and for a family plan is $16,600. Now, there's a few other requirements in order to be eligible for an HSA, and that means that you're not covered by any other plan that is a high deductible health plan. So if you're covered by a plan that is not a high deductible health plan, that would disqualify you. You can't be eligible for Medicare, and you can't be claimed as a dependent. So those are some of the other ones, but the most things we see is having to meet that minimum deductible and that max out of pocket with your plan. So let's dive into some powerful strategies that we can utilize with an HSA. And I like to say that an HSA is kind of like a retirement plan on steroids. I want people to be thinking about an HSA as a retirement plan, not necessarily a health account. And why is that? First off, you have the triple tax benefit. You don't get this in any other vehicle from the IRS. This is a gift from the IRS that we don't get anywhere else. When we get a tax deduction going in, we get tax-free growth, and we get tax-free withdrawals if we use it for qualified medical expenses. But in order to use this as a retirement account on steroids, we need to ensure that we're investing the funds inside the HSA. And that's the key benefit. I want people to say, let's use cash for qualified medical expenses at any time, and then let's save and invest the money in the HSA because it's growing tax-free and we can withdraw tax-free. So let's let that grow in a tax-free environment. And so, that's some of the power we find. Again, we want to ensure that we're investing inside the HSA, because a lot of times when people put money into an HSA, it doesn't automatically get invested, but you have full control over that. And we'll talk about that, but you have full control over that investment. So again, we say use cash to pay for medical expenses and let that account grow. So that's powerful tax strategy number one. Number two is that you can take distributions for qualified medical expenses at any time. So what does that mean? That means that, hey, let's say that we're paying cash for these medical expenses. We're paying cash. We have a child, we're paying cash. We have this medical bill, we're paying cash. We're going to save those receipts, because if we hit a time crunch, maybe that's 5 years from now, maybe that's 7 years from now, we can take those receipts and get reimbursed from our HSA for it. So we can take distributions for qualified medical expenses at any time. That distribution does not have to come on the date that the transaction occurred. As long as you have proof that it was a qualified medical expense, you can get reimbursed for that at any time. Again, that's why we always recommend to pay cash for medical expenses. If you can afford it, pay cash for medical expenses, let this thing grow and invest. And hey, if you run into a tight spot, keep those receipts and get reimbursed for that at a later date. Tax strategy number three, the powerful strategy behind this, is to self-direct, and again, making sure that we're investing in this. You have full control to do whatever you want that your provider allows within your HSA. So you can invest in stocks, bonds, mutual funds, whatever you might want to be. You can also self-direct. Maybe you want to have your HSA do some retirement investing or real estate investing. You can do that within your HSA as long as your provider allows for it. So use it smart. Think of it as a retirement vehicle and invest it as such. And then the final piece is that we want to try to avoid the withdrawal trap. So if you withdraw for non-medical reasons, so if you take funds out of the HSA for non-qualified medical expenses, you're going to pay a 20% penalty, plus you're going to pay income taxes on that. But here's the cool thing. If you're 65 or older, you can withdraw for anything without penalty, so non-medical items without penalty, but you're still going to face tax on it. So think of it like a traditional IRA, where you got a deduction going in, it grows tax deferred, but you have to pay tax on it with your withdrawal. Now, if you're using it for qualified medical expenses, no tax at all. Again, that's the triple benefit. But let's say you get to retirement and you say, I don't really have medical items, but I do need some cash. No problem. You can withdraw from it tax-free or penalty-free, but you're still going to have to pay taxes on it. So let's kind of just wrap up everything that we talked about. What is an HSA? It's basically a health savings account that allows you to contribute money to it pre-tax to pay for qualified medical expenses. Qualified medical expenses can be a wide range of different types of activities. And the big benefits of an HSA is the triple benefit. You get a tax deduction going in, The growth is tax-free, and withdrawals are tax-free if they're used for qualified medical expenses. Now, the other benefits of an HSA is that it is not a use it or lose it account. It can grow and keep on growing. You don't have to use the funds in it year after year. It keeps rolling over year after year. You can invest inside an HSA, and it's portable. If you change job, your HSA moves with you. It's not stuck with your employer. Now, for 2025, if you have an individual plan, you can contribute up to $4,300 into an HSA. That's the max. If you have a family plan, the max is $8,550. Again, what qualifies, what makes you eligible to contribute to an HSA? You have to be covered by a high deductible health plan. And that means that your minimal deductible, if you're an individual, is $1,650, or if you have a family plan, it's $3,300, and your max out of pocket, it's $8,300 if it's an individual plan, or $16,600 if it's a family plan. Again, some of the powerful strategies that we talk about with HSAs, think of it as a retirement account. Used cash to pay for medical expenses, and let this HSA grow. Let this HSA be a wealth building tool for you because of the triple tax benefit that we don't get anywhere else, and ensure that you're investing inside that HSA. Another key thing is that you can take distributions for qualified medical expenses at any time. So if you're paying cash for these medical expenses, save your receipts, and if you run into a point where you need some cash, you can take those receipts and get reimbursed for those qualified medical expenses that happened a year ago, 2 years ago, 3 years ago, 5 years ago, whatever it might be. Again, don't forget to invest inside that account. Think of it as a retirement account, not just a savings account. It's a retirement account. Invest the funds in there because you got the beauty of tax-free growth inside there, as well as tax-free withdrawals, and avoid the withdrawal trap. Basically, that means that if you withdraw from that HSA for non-qualified medical expenses, there's a 20% penalty, plus you pay your income tax rate on that withdrawal. Now, if you're 65 or older, the penalty goes away. You're just going to pay taxes on it. So now that you know, the HSA isn't just for doctor's visits. It's your secret weapon to retire tax-free and outsmart the IRS in a legal way. You get triple tax savings. You get lifetime rollover. You get investment potential with inside it. If you use it right, it could be the most underrated wealth tool in your arsenal. Want help setting it up properly, or need to know if your plan qualifies? Head on over to taxhelm.com or book a free call. There's a link in the description. And don't forget to subscribe to me for more real tax strategies to grow your wealth and pay less tax legally.